Living off dividends demands a sufficiently passive income-producing portfolio. Have you ever felt that your efforts could have been more fruitful? Do you think a 9-to-5 job is not the center of your life? To escape from and excel outside of the rat race, save and invest. This video will explain how you can achieve financial freedom with a proven strategy for living off dividends. To live off dividends and become financially independent, you need to build a portfolio of assets that gives you enough dividend income to cover your living costs so you don't need a job. As usual, invest in a diverse mix of dividend-paying equities, REITs, and other income-producing assets. An investor may compound growth and income by reinvesting dividends. This technique aims for financial independence and freedom from a 9-to-5 job. Passive income, financial independence, less stress, flexibility, diversification, and a long-term perspective are all advantages of living off dividends and attaining financial freedom. Stay until the end of this video because we'll discuss important information regarding your financial freedom. What are dividends? Dividends are payments made by a company to its shareholders, typically quarterly or annually. These payments are usually a portion of the company's profits and are distributed among shareholders in proportion to the number of shares they own. There are two main types of dividends. Cash dividends are the most common form of dividends, where a company distributes cash payments to its shareholders. And stock dividends. Instead of paying cash dividends, a company may issue additional stock shares to its shareholders. This is also known as a stock split. There are several types of investments that pay dividends, including stocks. Many publicly traded companies pay dividends to their shareholders. Blue-chip stocks, particularly those in stable industries such as utilities, consumer staples, and healthcare, are typically considered to be reliable dividend payers. Real estate investment trusts, or REITs. These companies own and operate income-producing real estate such as office buildings, apartment complexes, and shopping centers. REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. And mutual funds and exchange-traded funds, or ETFs. These are pools of investment managed by a fund manager. Some mutual funds and ETFs focus on dividend-paying stocks and may pay dividends to shareholders regularly. Bonds. Some bonds pay regular interest payments to bondholders, which can be considered dividends. It's important to note that dividends are not guaranteed, and companies can change their dividend policies or even stop paying dividends if the financial situation changes. The importance of diversification. Diversification is an investment strategy that involves spreading your money across various assets to minimize risk and maximize returns. The idea is that by spreading your investments across different types of assets, you can reduce the overall risk of your portfolio by reducing the impact of any particular investment. The role of diversification in minimizing risk is based on the concept of not putting all your eggs in one basket. By investing in various assets, you reduce the risk that the performance of any one investment will significantly impact your overall portfolio. Maximizing returns is also an important benefit of diversification. Investing in various assets allows you to take advantage of different market conditions and benefit from the returns of different investments. Tips for building a diversified portfolio include investing in various asset classes such as stocks, bonds, and real estate. Investing in different sectors such as technology, healthcare, and energy. Investing in different countries to spread your risk across different economies. And rebalancing your portfolio regularly to ensure that it remains diversified. It's important for you to know that diversification does not guarantee a profit or protect against the loss, but it can help reduce the overall risk of your portfolio. It's also important to consult a financial advisor before making investment decisions. The role of passive income in achieving financial freedom. Passive income is earned without the need for active involvement or effort. This means that once a source of passive income is established, it generates income with little or no additional work required. A common definition of passive income is income received regularly with little effort required to maintain it. Some examples of passive income sources include rental income from property, dividends from stocks or mutual funds, interest income from savings or bonds, income from a business that runs on autopilot, such as a website or an app, and royalties from books, music, or other creative works. The benefits of passive income for achieving financial independence include it allows you to earn money even when you're not actively working, which can help you reach your financial goals faster. It can provide a stable and predictable source of income which can help you plan for the future. It gives you more flexibility and freedom as you're not tied to a specific job or employer, and it can help you to achieve financial independence by providing a source of income that is not tied to your time or effort. Building a significant source of passive income can take time and effort, and it's not a get-rich-quick scheme. However, if done correctly, passive income can be a powerful tool for achieving financial independence and reaching your financial goals. How to start living off dividends. Living off dividends is a strategy where an individual relies on the income generated by their investments to cover their living expenses. Here are some steps to help you start living off dividends. Build a portfolio of dividend-paying investments. This includes stocks, exchange-traded funds or ETFs, and mutual funds that pay dividends. Look for companies with a history of consistently paying dividends and a solid financial track record. Reinvest dividends to maximize returns. Instead of taking the dividends as cash, reinvest them into the same or similar investments. This allows your money to compound and grow over time. Diversify your portfolio. Diversifying your portfolio across different sectors, industries, and countries can help reduce risk and increase returns. Track and manage your portfolio. Keep track of your investments and monitor their performance regularly. Make adjustments as necessary to ensure that your portfolio remains balanced and aligned with your goals. And have a plan for unexpected events. Dividends are not guaranteed. Some companies may reduce or stop paying dividends in difficult times, so it's important to have a plan in place for unexpected events. Reinvesting dividends is a strategy where instead of taking the dividends as cash, they're used to purchase more shares of the same or similar investments. This allows your money to compound and grow over time. Here are some strategies for reinvesting dividends to maximize returns. Dollar cost averaging. This strategy involves reinvesting dividends by purchasing more shares at regular intervals regardless of the price. This helps to average out the cost of the shares over time, reducing the impact of market fluctuations. Value averaging. This strategy involves reinvesting dividends by purchasing more shares when their price is low and fewer shares when their price is high. This helps to maximize returns by buying more shares when prices are low and fewer shares when prices are high. Tax-efficient reinvesting. Consider the tax implications of reinvesting dividends. Some investments may be taxed at a lower rate than others, so it may be more beneficial to reinvest dividends in certain types of investments. Diversify. Reinvest dividends in various investments across different sectors, industries, and countries to reduce risk and increase returns. Consider reinvesting in other asset classes. Reinvesting dividends in other asset classes like real estate, bonds, or other income-generating assets can help to diversify your portfolio and increase returns. Tips for managing and tracking your portfolio. Use a spreadsheet or financial tracking software to keep track of your investments and dividends. Review your portfolio regularly to ensure it is aligned with your goals and diversified. Be prepared to make adjustments to your portfolio as needed, and consider consulting with a financial advisor to help create and manage your portfolio. Dividend investing can be a good way to generate passive income, but it's not without risks. Dividend can be reduced or eliminated by a company. The stock prices can go down, and you should always do your research and consult a financial advisor before making any investment decisions. Now let's discuss some case studies of persons who have achieved success through dividends. But before we move to that, make sure to hit the thumbs up icon below to like this video. Many individuals have achieved financial freedom through dividends. Here are a few case studies of individuals who have successfully implemented this strategy. Jim O'Shaughnessy is a well-known author and a successful investor who achieved financial freedom through dividends. He has been investing in dividend-paying stocks for over 30 years and has written several books on the subject. One of his key strategies is to focus on companies with a history of consistently paying dividends and a solid financial track record. Dividend Growth Investor is a website run by a person who uses the pseudonym Mr. Dividend. He achieved financial freedom by investing in dividend-paying stocks for over a decade. He has shared his journey and lessons learned on his website, inspiring many others looking to follow in his footsteps. And J.L. Collins, who is a retired businessman who has achieved financial freedom through dividend investing. He has written a popular book, The Simple Path to Wealth, in which he shares his strategies and lessons learned. He advocates a simple, low-cost, passive approach to dividend investing. Lessons learned and advice for others looking to follow in their footsteps. Invest in dividend-paying stocks, ETFs, or mutual funds with a history of consistently paying dividends and a solid financial track record. Reinvest dividends to maximize returns and let your money compound over time. Diversify your portfolio across different sectors, industries, and countries to reduce risk. Have a plan for unexpected events and be prepared to adjust your portfolio as needed. Consider consulting with a financial advisor to help create and manage your portfolio and invest for the long term and avoid chasing short-term gains. Achieving financial freedom through dividends is not a get-rich-quick scheme. It requires patience, discipline, and a long-term mindset. Dividends provide investors with stable income. Diversifying a portfolio with dividend-paying stocks, ETFs, and mutual funds and putting the dividends back into the portfolio may lower risk and increase long-term profits. Financial independence may be achieved through diversifying, reinvesting, and building a dividend-paying investment portfolio. Omega Finance recommends establishing a dividend-focused portfolio with the aid of a financial advisor. Consistency and dedication are the keys to success, and dividends can provide financial independence. Remember to subscribe to the channel and press the bell icon before leaving this video. Do you have any future plans for investment in dividends? Do you still have any queries about living off dividends? Tell us in the comment section below because we value your feedback. We've also uploaded a video on the 5 best dividend stocks in India with high growth rates on our channel, which can be very helpful to you while investing in dividend funds in 2023 and beyond. You can find the link to that video in the description below and in the card.